Wealth creation for the long term need not be complex. Young earners worry about too many choices before them. Retired investors stress about whether they have enough wealth. Middle-aged investors wonder if they are on the right track. Follow 4 principles to keep it simple. First, take stock of your existing savings. Put them into 5 categories: equity, debt, precious metals, cash, property. Equity shares, IPOs, equity funds, PMS are all equity. Money invested in your own business is also equity even if it is not a listed company. Put all investments in risky equity capital for long-term growth into this category. Your investment in the PF, PPF, deposits, bonds, post office and everything else that returns the principal after a particular time and pays interest is debt. Your diamonds, gold, silver, inherited jewelry and coins can all be classified as precious metals. Whatever lies in your savings account or in your vault is cash. Property includes everything in real estate that you buy, that is residential, commercial or land. As long as you are not spending all that you earn and are putting something aside in one of these, you have begun well. Second, ensure that your wealth is spread well across these categories. In other words, diversify. You might buy a house early in your career. You may be churning your money in stock trading and IPOs without a specific plan. You could be investing via SIPs in a dozen funds hoping they turn out fine in the end. It is fine if you have spent a few years of your life building one type of asset, focus on others in the next few. Building debt investments first, adding a home and equity next, and spending the rest of your earning life making each of these bigger is not bad at all. Third, correct imbalances in a steady manner. Your objective may have been to take on risky assets early in life. In the middle age of low expense and high saving, buying property might become an obsession. In the retired phase, there may be an overt focus on protecting capital and getting an income. Long-term wealth building needs balance. If all your saving is going back into your business and you have bought property with all the gains you could stash away, recognize the lack of debt in your portfolio and begin to build it. Fourth, protect and fence your wealth from your emotions, insecurities, overt optimism, and mistrust. Do not stake your wealth to win by trading in stocks. Set aside a portion of your wealth in debt products before pursuing your dreams so that your family is protected. If you invest only to save taxes, your wealth will suffer due to poorly chosen products. If your wealth is in a property that you want to pass on to your children, you may be holding unproductive assets. If you buy gold only because it makes you feel good, you may have an asset that earns no income. Recognize and check emotions that may lead you to overdo something and harm your wealth. Building wealth is about allocating your savings across diverse products, ensuring a balance, and keeping emotions in check. Do not miss the woods for the trees, trying to search for the next best thing to buy or panicking about economic cycles. You have at least 45 years or more after you turn 21 to build and enjoy your wealth. That is long-term orientation for you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.